Title: Managing Risk to Reward Ratio in the Share Market. Introduction. Investing in the stock market can be a rewarding but inherently risky endeavor. One of the key principles that successful investors adhere to is managing the risk-to-reward ratio effectively. This ratio is a crucial metric that helps investors strike a balance between potential profits and potential losses. In this comprehensive guide, we will delve into the details of how to manage the risk-to-reward ratio in the share market. Understanding risk-to-reward ratio. The risk-to-reward ratio is a simple yet powerful concept that quantifies the potential profit against the potential loss in a trade or investment. It is expressed as a ratio, such as 1:2, where 1 represents the risk and 2 represents the reward. In other words, for every unit of risk undertaken, the investor aims for a potential reward of 2 units. Setting realistic goals. Before entering the share market, it is crucial to establish realistic financial goals. These goals should be aligned with your risk tolerance, investment horizon, and overall financial objectives. Having clear goals allows you to determine an appropriate risk-to-reward ratio for your trades, ensuring that it aligns with your broader investment strategy. Risk assessment. Conducting a thorough risk assessment is the foundation of effective risk management. This involves analyzing various factors, including market conditions, company fundamentals, and external influences. By understanding the potential risks associated with an investment, you can make informed decisions on position sizing and set stop-loss orders to limit potential losses. Diversification. Diversification is a fundamental risk management strategy. Instead of putting all your eggs in one basket, spread your investments across different sectors and asset classes. Diversification helps mitigate the impact of poor-performing investments on your overall portfolio and reduces the risk of significant losses. Position sizing. Determining the appropriate size for each position is crucial in managing the risk-to-reward ratio. Avoid investing a disproportionate amount of your portfolio in a single stock. By allocating a reasonable percentage of your capital to each position, you can control potential losses and protect your overall portfolio from significant downturns. Setting stop-loss orders. Implementing stop-loss orders is a proactive way to limit potential losses. A stop-loss order automatically sells a security when it reaches a predetermined price, preventing further losses beyond a specified point. This tool is essential in ensuring that losses are kept within acceptable limits, thereby maintaining a favorable risk-to-reward ratio. Risk-reward analysis. Before executing any trade, conduct a thorough risk-reward analysis. Assess the potential upside compared to the potential downside and determine if the risk-to-reward ratio meets your predefined criteria. A favorable risk-to-reward ratio typically involves seeking investments where the potential reward outweighs the potential risk. Continuous monitoring and adjustments. The stock market is dynamic, and market conditions can change rapidly. To manage the risk-to-reward ratio effectively, it is essential to monitor your investments regularly. Stay informed about market trends, company news, and economic indicators. If necessary, be prepared to adjust your positions or exit trades to align with changing market dynamics. Conclusion. Successfully managing the risk-to-reward ratio in the share market requires a combination of strategic planning, disciplined execution, and continuous monitoring. By understanding the importance of this ratio, setting realistic goals, implementing risk mitigation strategies, and staying vigilant, investors can enhance their chances of achieving sustainable and profitable outcomes in the dynamic world of stock trading. Title: Managing Risk-to-Reward Ratio in the Share Market. Introduction. Investing in the stock market can be a rewarding but inherently risky endeavor. One of the key principles that successful investors adhere to is managing the risk-to-reward ratio